The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 14th of March. Jeremy, good to have you back.
Hi, Gareth. Yeah, good to be here.
So it's been yet another very interesting week, once again dominated by Trump, the White House, and what they're doing and what they're saying, which isn't always the same thing. So let's start with the US and the global markets, and then we can talk UK.
Yeah, what a time to be alive, as they say. How many new tariff measures have been introduced this week and how many have been removed or deferred? Hard to know, really, and I suspect even the White House can't be sure. I don't know about you. Have you got a favourite yet?
Yeah, I'm looking forward to the cheap French wine when they're unable to sell it into the US with these 200% tariffs that Trump's, I think he's only threatened those. He hasn't put those in place yet.
Yeah, but, exactly. Yeah, 200% tariff on EU alcohol and just wait for the French wine to be dumped into the UK market. But the Trump administration continues to flood the end zone and keeping everybody guessing about what they're going to be doing today, tomorrow, this week, next week. But, the people around him, in many ways, they're more MAGA than he is. And they're loyally committed to effecting the change that he talked about last time, but was unable to do much about or to push through. We've had J.D. Vance tell Europe and Zelensky that he's serious about ending the forever wars and he's not paying for Europe's security if Europe is not prepared to play by their rules. And now we've got Scott Bessent, who's the Treasury Secretary, and he's basically told Wall Street that it can look after itself. And the priority is Main Street, not Wall Street. The Trump voters are not typically asset rich. They're more concerned about the cost of their mortgage and the level of inflation, and particularly on medium and longer term interest rates. It's all about the bond market than the equity market. That helps the Trump base, but it also helps Scott Bessent. I mean, the MAGA base, might be worried about refinancing their mortgage. Well, he's got the small task of refinancing $9 trillion worth of government debt. So the shared interest is on the 10-year Treasury yield, not the level of the NASDAQ. So we heard Trump this week say, markets are going up, then they're going down. But you know what? We have to rebuild our country. And that comment was sort of later backed up by one of his aides who said, the biggest win is if businesses move into our country and produce jobs. That's a bigger win than the tariffs themselves. The America last globalist era is now ending. So they see themselves as being disadvantaged in nearly every aspect of their interaction with the rest of the world, and they are set on changing that.
It's almost inconsistent, though, with the way that Trump's put tariffs in place to force other governments to the negotiating table, Mexico and Canada, most obviously. And that's maybe a tactic to get people to close the borders or stop the flow of drugs or whatever he might be ranting about at the time. But it does feel like these are potentially more structural, longer-term tariffs. But I think unless investors become clear on that, no one's going to build factories on the basis of tariffs that feel like they might be removed or altered by the week.
Correct.
So it's going to take a while for that to work through or to bed down properly.
I think that is the essence of the dilemma. But intentionally or not, the equity market has finally got the memo and taken fright. The volatility measure, the VIX, is up. Credit spreads are starting to widen. The market is jittery and heading down. So the NASDAQ 100 is down 13%. So, we're in the level of a correction rather than a bear market still. Mm-hmm. But if you compare that over the same period, the German market, the DAX, is up over 20%. So year to date, Germany has outperformed the NASDAQ 100 by something like 34%. And in terms of borrowing costs, US Treasury yields are broadly flat since the US election date. Germany's Bund yields have increased from circa 2% to nearly 3%, which is huge. I was talking to Marcus Ashworth this week, who's a Bloomberg opinion writer. he said that some investors are now expecting US Treasury yields to be lower than German Bund yields by the end of the year. So the market is beginning to fear this change becoming a huge pivot. And, Germany is essentially trying to turn on a dime here. In essence, they're showing us how to do a truss.
Hopefully in a slightly more effective way.
And the way to do it is you start with a decent balance sheet, because they're starting from a position where they're not actually that indebted. Germany is the biggest economy in Europe. So the fact that it is now unleashing that balance sheet in this sort of probably €1 trillion fiscal boost changes the game. But this pivot is taking shape, and the US economy is weakening. And, while everyone's blaming the Trump tariff policies, the reality is we haven't seen that yet. The fact is it is getting factored into US asset prices in terms of lower bond yields and a lower stock market. Also this week, we had the US inflation print with headline CPI coming in lower than most people had forecast, which is a good thing. But it wasn't sufficiently low to really cool these underlying core annualized inflation measures. And the core PCE measure, which we, I think, are getting in the next week or two, probably hasn't been impacted sufficiently year to date for the Fed's next move to be down or to really change this idea of where the trajectory on US rates is coming from. So it's worth bearing in mind that the core annualized US inflation measure has now been above Fed target for 4 years. So we've got this pretty ugly scenario shaping up. And the question is for how long, of a lower GDP growth in the US, but a stubbornly high level of inflation above target. And throughout this, the level of the dollar has remained relatively subdued, i.e. weak, which I think is a key feature of this period in the market, because normally in periods of volatility and increased uncertainty, you'll see, all other things being equal, a rise in the dollar as people buy dollar assets because they see it as a safe haven. And this time round, it is not happening. Without doubt, the firmest asset this week has remained gold, which is on the verge of this sort of $3,000 ceiling that it's bumped up against a few times in recent weeks. So there is clear evidence that capital is exiting the US or starting to exit. And the beneficiaries so far, I would say, have been European, particularly German equities and precious metals.
It's ironic the way the US saber rattling or pushing of Europe to start spending more, especially around defence, and especially by Germany. Ironically, that might be reflating or bolstering the German or European markets just at a time when the US is really slowing down.
Absolutely. Yeah.
How about the UK in all of this? How have we fared?
We continue, I'd say, to remain sort of out of the direct firing line from a global capital flows perspective. As usual, we're sort of hung between the US and Europe, and be good to focus on the economic and the financial implications of all this. The politics in the UK, I think, are very interesting. I don't know if it's just me, but isn't Keir Starmer all of a sudden coming across a bit Trumpy?
Yeah. Well, he's cutting costs and he's trimming welfare spending and trimming the NHS, both of which have been quite unexpected.
They put something in his tea when he went to visit Trump in the White House, maybe. I don't know. But at this rate, he'll be wielding a chainsaw at the party conference later this year.
Just imagine.
From a geopolitical point of view, Starmer sees his role as a bridge between Europe and the US. At some point, I think events will dictate that he and the UK are going to have to jump one side or the other increasingly. And I think he is making noises to the Trump administration because he wants a trade deal and he wants to be able to have his cake and eat it. And I think that's going to be a very difficult line to take.
Fingers crossed he manages it. But yeah, there's an awful lot on his plate at the moment trying to work out which way to steer things. So we'll be interesting to see how that evolves over time.
So, yeah, as ever, lots going on from a macro level, but also quite a busy time for companies reporting in the UK. So what have you seen there this week?
There has been a lot. I mean, starting with the progressive clients, we had 4 in particular that caught my eye. STV, the Scottish broadcaster, they had an FY24 that was pretty much in line, slightly ahead actually, and they've got an ongoing push towards content production and streaming, which are their higher growth markets. So that's good to see. And the new chief exec there has announced that he's going to be discussing a refreshed strategy, but so far so good. Then in the building construction space, we had a sort of a mixed bag. We had Forterra, the brickmaker, who gave a pretty good end to 2024 in their results statement. And they were quite upbeat about 2025 and beyond, obviously, as the market's picking up, supposedly on the back of the various planning reforms that Labour have been talking about and the housing targets they're really trying to deliver on. So Forterra is saying there's some quite good opportunities and steadily building levels of demand across the construction space. But on the flip side, Elle, who are involved in sort of early stage groundwork and early construction in a number of building projects, they had a warning. Essentially, they were saying that they've seen a number of delays due in large part to problems at the building safety regulator, who's been unable to keep up with the number of developments and projects coming through. So everything's been slowed down, and regulation, despite what Labour are saying, it's the regulator which is getting in the way and holding up a number of these projects. Then we had a piece of news from Secure Trust Bank just yesterday. They delivered FY24 results slightly better than expected, and that allowed them to effectively reaffirm their confidence in their medium-term targets and guidance. So a reasonably good outturn from Secure Trust Bank. In particular, they talked about the vehicle finance market, where their commission payments, there have been a number of worries about those or what levels of redress they might be forced to pay. It feels like they're starting to get their hands around that a wee bit, actually. They talked about the fact that their discretionary commission arrangements, which are the real issue, those might be containable. So it's starting to look like Secure Trust Bank is able to manage or at least contain that risk or those numbers there. So that's been, I think, quite well received. And we're looking for the business to get to a 14% return on equity over the next couple of years, which would be quite a good outcome for that business. How about you? What other news have you seen across the market? It's been quite busy, hasn't it?
Yeah, it has. Yeah, it's been a busy week. We had Cakebox raise money and make an acquisition of an Indian sweet business, which looks pretty complementary to their existing business, and it'd be good to see that the equity capital market is being put to good use. We've had an agreed takeover offer for what used to be called Impact Healthcare REIT, but is now known as Care REIT, and it has been agreed to be taken off the UK market by a New York listed REIT, which is further evidence of how attractive the UK market is. But I think it's also an example of how the investment trust sector for alternative assets has a structural problem in terms of having a business in the shape of Care REIT, which has plenty of opportunities to invest and grow its asset base, but it basically said this week that its difficulty in raising new capital with high interest rates and a share price well below NAV had constrained its abilities to pursue these opportunities. So basically, it's given up the ghost and handed itself over to the ownership of another REIT listed in New York, which seems to illustrate this structural issue that we have in the UK market.
It's a real shame, yeah.
The other thing I noticed was Science Group increasing its stake in Ricardo. Both businesses of a similar size, but Science Group now has a 15+% stake in Ricardo. It'd be interesting to see how that plays out. And we had another exit this week from AIM with Hornby, which is a shame to see. So a mixed bag, but a lot going on, and the market getting on with its day-to-day business while the macro turmoil is carrying on above it. Yeah.
And how about this coming week? What have we got macro-wise coming up?
We've got the Bank of England rate decision on Thursday, and we've got the Fed with its rate decision on Wednesday, both of which currently have policy rates of 4.5%. And it is expected that both central banks will keep their policy rates unchanged. The other one we've got on Wednesday is the Bank of Japan. The expectation is for Japan to leave its rates unchanged as well this week. But I would say if there is a surprise, that rate is likely to be increased. If past experience is any guide, the last time we were surprised by a Bank of Japan rate decision was in July last year, and that had pretty negative consequences for stock markets. So if anything, I would watch for the Bank of Japan rate next week rather than the larger ones.
Yeah, the journalists might be dusting off their explanations of the carry trade once again if we need to get into that. Hopefully it's not as severe as it was then. But yeah, that would be interesting to see how those various interest rate decisions play out during the course of next week. Great, Jeremy, fantastic wrap up. Thank you very much indeed, as always, and look forward to catching up this time next week.
Okay.
Talk to you then.
See you then.
Thanks.
Brought to you by Progressive Equity.